Hi, everybody. My name is Leon Hubby. I want to welcome you to the video. This is the Home-Based Business Tax Primer, how a home-based business can put dollars into your pocket. So let's go ahead and jump in and get started on this. First thing I'd like to point out is some points worth noting as I'm going through this. Number one being, just by starting a home-based business, you can put extra dollars into your current paycheck. The IRS says that we're entitled to these deductions regardless of profitability if we play by the rules. Number two, the tax benefit is extra. It does not reduce your typical refund. You're creating an extra deduction with your personal expenses that lowers your taxes. And the national average tax saving can be worth up to an extra $4,000 a year, so it's not insignificant. Finally, number three, you don't do extra work to document your business. You do the work differently. If you're paying your bills already, you've already got 90% of the work already done and documented. So let's go ahead and let's jump into it and give you an explanation of where this all came from. First off, the tax rules are different for employees and business owners and has to do with earning a wage versus generating a profit. When Congress got together and decided to write the laws, they decided to look at it in two different directions. One was for employees and one for business owners. With employees, what they decided was you were going to earn your income, you're immediately going to get taxed on it, and then you could spend what you had left over on your expenses. And you see that every day when you go to get your paycheck, and you've already got payroll taxes and income taxes taken on. Well, for the business owner, it's different. When he earns his income, he gets to spend his money first, and then he gets taxed on what's left over. There is none of that intermediary pulling money out by the government. They get to control when they pay taxes and how they pay taxes. Let's take a look at a quick example of how that can impact us. If you're an employee, and let's say you're earning $3,000 a month or $36,000 a year, you're probably going to have a marginal income tax rate, and we're talking about income tax here, not payroll taxes, of about 20%. So you're going to pay around $600 a month in taxes, meaning you have $2,400 to spend. Now, but on the business owner side, if he earns $3,000 a month, we'll keep it the same so we have an apples-to-apples comparison, and he spends the same amount of you to do that, $2,400. He's going to have $600 that he's going to be taxed on, meaning he pays $120 worth of tax, but you're paying $600. Well, that's a $480 difference that he has extra into his pocket. I don't know about you, but to me, that is a big difference. So where does that come from? Why is that the case? Well, when Congress got together and wrote the tax laws, they looked at it from a taxing perspective. And they said, look, as an employee, you have non-business related personal expense. You're going to pay that post-tax. You're not going to get any break from it. And the reason for that is you're taking capital out of the company that's paying you that wage. Now, with the business owner, they recognize that they have business-related expenses. And they said, look, we're going to let you take those expenses pre-tax to offset revenue for a break on your taxes. And the reason for that is they're using capital, money that they have, to create a cash flow. And the government wanted to give them a benefit on that. So that raises a question for us as we're considering the tax rules here. Is there a way for us to use the business owner rules? Because we want to use those rules. They're much more favorable to us. If we could do a lot of our expenses pre-tax, it would save us a bunch of tax money, and we can use that for a lot of different things. Well, the answer to the question is yes. Congress has provided a loophole for us. You create a home-based business, and you can convert personal expense into business expense. Here's how that loophole works. Special rules apply for a home-based business. The IRS recognizes that you're using personal assets and expenses to operate your business. The IRS then allows you to convert the business use portion of that personal expense into business expense. This will reduce your current tax situation. The IRS will allow you to deduct the business use portion of your personal expenses as business expense, reducing your wage income before your tax calculation is made, reducing your taxes. Now, these are expenses that you're already paying post-tax, right? Stuff like your cell phone, mileage getting reimbursed for your car, insurance on your car or your home, your electric bill, your water bill, and a whole host of other things. But now you can pay them with pre-tax dollars. They allow this because you're using those expenses to run your business and because you are active and not passive in your business. That allows you to use the expense to offset excess earned income after business income. So if you have little to no income yet, like you just started your business or it's building slowly, it can all be used to reduce your tax liability from your earned income. Generally, too, these expenses are consistent and predictable, right? Your cell phone doesn't generally change, your electric bill doesn't generally change, your insurances don't generally change, your water bill doesn't change. A lot of the expenses stay consistent. So what you can do is you can predict them, you can make a calculation, and you can file an updated W-4 form with your employer and keep a portion of the difference in your paycheck. And what do you do with that amount? Well, our suggestion is to fund your business and operate it. And then if you have any left over, put that money into your current budget to make your life more pleasant. Let's go ahead and let's take a look at a real world example of how it might impact us. You've got your job, you're earning your $3,000, you're paying your taxes, and you got $2,400 to spend. But you decide you're going to start your own business. Let's call it mybusiness.com. Since this is related to the Income Factory, we'll assume that it's an Income Factory job that you're doing. You're helping us promote the website. When you do that, the first thing you'll do is decide how much time you're going to spend in your business and how much time you're going to spend in leisure. For this, we're going to assume it's 60-40, 60 in your business and 40 in leisure. You'll have two forms of expenses in your business: operating expense, what it takes to run your business, and home office expense to do the administration and management of your business. As operating expense, you'll use your cell phone, your internet. You'll have supplies that you use. You might have meals that you deduct, mileage, promotional costs, and childcare. So, for example, if your cell phone is $45 like me for a T-Mobile plan, you can deduct $27 of it. If your internet's $75, you can do $45. Now, we have accumulated a lot of expenses and supplies in my house. So we just go ahead and use those supplies and we charge the business for those uses. It's $15 a month. The meals are $120 deduction for us. I go out 3 times a week, but I also take people out and tell them about what we're doing in the Income Factory and ask them to take a look at the information. And when I do that, I can deduct those or some of those costs as meal expense for the business. Mileage, $187 deduction, because I drive near 300 miles per month with the reimbursement rate of 62.4 cents on that. Those miles come from me leaving my place of employment to go home and work on my business. It can be when I leave to go to work, but I stop at a Starbucks and I meet a couple people or drop some cards off so people will know. It's in support of getting the supplies and going for those meals, etc., things like that. Now, the promotional expense, we have a direct one from GDI, right? Because we get a domain name package for $10 a month, so I can deduct that as well. But all my kids are adults, so I don't have any child care expense. But if you put your children in child care, you can deduct a portion of that as well. We're going to assume here that it's 0 for that one. And then there's the office expense. And here's how the office expense works. If you have a dedicated room space that you do your business management in, your home office, you can deduct the proportional amount of floor space to the house and take some of the home expenses. Now, you can't use your kitchen table. You can't use your dining room table. You can't use the corner of your bedroom unless you wall it off and make it a room. You could use a walk-in closet. You could use your basement. You could use your attic. In my case, I use our living room because we don't entertain in it at all, and I just converted it over to my office. But that allows you then to take home deductions. For example, rent or mortgage interest. Let's assume that you're renting a townhouse for $1,500 a month. In this case, at 10%, you'd be able to take $150. If your electricity is $110, you take $11. You get utilities at $16, insurance at $10, maintenance and repair at $5, and if you bring somebody in to clean or you're responsible for lawn care, you can deduct that as well. We're going to assume that it's 0 in this case. That totals $596 in deductions, real-world deductions. So let's see how it impacts you. On the left is your old case. You were just an employee. You earn $3,000 a month. You pay your $600 in taxes, and you pay your bills and what you got left over. But now you're a business owner, so it gives you a new picture. You don't have any income yet, so you take that $596 and you subtract it from your earned income, $3,000. It gives you new taxable income of $2,404. When you tax that at 20%, you're paying $480 in tax instead of $600. Well, that's a $120 difference that you put back into your paycheck. And you're either offsetting $596 in business revenue, or if you haven't got any revenue yet, you are putting $120 back into your paycheck. Now, to me, that is a no-brainer and a big deal to do. So let's summarize a couple of important points that came out of that. I want to make sure that you understand what we're talking about. Number one, because you're created a home-based internet business and are active, you can take excess expense after you offset business income and apply it against your earned income to reduce your tax liability. You are entitled to this deduction regardless of profitability. So if you haven't made any money yet, you can use the full amount to offset your earned income. And you've already affected your bottom line because you've given yourself extra money that you found because you've been able to lower your taxes. Number two, since you have regular expenses, you can budget and deduct those expenses monthly to increase your monthly paycheck. You can use it in the fashion of a month-to-month increase in that paycheck. Three, you reconcile at the end of the year or the month versus your actual income and expenses. And it's usually a net positive to your bottom line until you generate revenue. The reason for that is once you start generating revenue, you have to pay tax on it. But you're increasing your revenue, so you really are still increasing your bottom line positively. And finally, four, you can affect your bottom line by your actions alone. It doesn't take anybody else to do that. All you need to do is set up your business and execute it. No one has to buy into it in order for you to be eligible for those deductions and reduce your taxes. That's an important point. Now, there are rules, of course, that govern how we do this. So let's go over the rules and let's relate the rules with respect to the income factory so that you can understand how directly what we're meaning with a real example. To be legal, the IRS will evaluate this business based on three simple questions. Is the intent to make money versus just save on those taxes? Are the expenses both necessary and reasonable for the business? And does it serve some real business purpose? Let's go ahead and take a look at that. And with respect to business intent, what that means is to make money in some legal fashion, either by selling a product or providing a service or something like that. Here's what we do at the Income Factory. We teach and promote to people how to create and use a home-based internet business to their advantage. Every business must promote their product or service, right? You could have the best darn chocolate chip cookies in the world. You could put them online for people to buy and not a person will buy them unless they know that they're out there. You have to promote your product and have them come get it in order to do it. So you have to do some sort of promotion. Well, we set up our business to earn income using our unique domain names to actually promote the Income Factory directly. We get commissions when a partner enrolls as a result of our promotions, right? So it's tied directly to doing the promotion. So as long as, number one, you have a unique domain name, so you're plugged into the income stream and you can get commissions. Number two, you use your domain name to promote the Income Factory site and you physically ask people to go look, you make those referrals. You clearly demonstrate your intent is to make money since the actions earn you potential commission. You have a clear path to money through the commission pathway and you're taking action. So you have an intent to earn money. Now, number two is necessary and reasonable expenses. Okay, now necessary is defined as related to the business type. And for the Income Factory, it's promotional, right? So you can take any expense that's related to promoting the Income Factory site. You can use your cell phone. You can use the internet. You can take vehicle expense, meals and lodging for travel and entertainment, advertising and promotion. Anything that's related to that will work. And the home office expenses. Now, let me set up an example to illustrate what is not necessary. Let's assume that it's the middle of summer, you have this gigantic party barge, and you decide to throw a party on the party barge and invite your people. And when you invite them, you tell them all about the Income Factory business that you have. You decide you're going to deduct the party barge slip charge for doing that because you did your business on the party barge. Is the IRS going to accept that and allow you to do that? Well, the answer to that is probably no, they're not going to. Why? Because it's not necessary to have a party barge in order to promote an internet-based business. They're just not going to allow that expense. That's there to illustrate the type of business that you have and the expenses that have to be related to it. Now, if you had a business enhancing party barges, repairing party barges, cleaning party barges, absolutely, you could deduct the cost of yours as an example of your business. Now, reasonable. That one's actually pretty easy. As long as you're honest about the proportional use of your assets, the expenses mentioned above, there'll be no issue here. The reason for that is you're using standard generic plans. And you can demonstrate through your actions that you're working your business the proportional amount of time you want. So the IRS can easily check and verify that your expenses are reasonable there. So the bottom line is just be honest about what you're doing and you'll be fine. Now, the last one is business purpose. And you bet, in fact, there are 3 business purposes in case of the income factory. Number 1, the education of the public on how to set up and use a home-based internet business to their advantage. We give that information away, but we do it. All they need to do is go and watch the videos and they'll understand what's going on, then come talk and work with us, and we'll give you the rest of the information. Number 2, to promote the Income Factory website for the site owners so that we can potentially monetize the site if and when it becomes popular. Think about what's happening here. A domain name that you get is pointing to the site. A bunch of people are all pointing them to the site. People go to that site, they watch videos for 20 to 60 minutes. Well, that site could become very popular, and we could possibly monetize it by putting advertising in there. So what you're doing is we're hiring you to help us promote the site so we can potentially make an additional income stream for us out of the site. And finally, if you show somebody, they decide they want to come and be a partner and help promote, you're going to sell them a domain name package from GDI. They're going to get their name from you. So you're a sales agent for GDI as well. So there are 3 specific business purposes, and we meet all 3 criteria for this. So the Income Factory is a real business. Now, from a generic perspective, as long as you sell a product or service and you meet the other ones, absolutely, you have a real business in place. All right, now that's primarily it. There's not a whole lot more you need to know there. If you have questions, though, go to your CPA or your accountant and ask them. We're not experts. We have gone to our accountant and CPAs to go and get things verified. But if you doubt anything or you have questions, ask them and they will answer those questions and solve any issues that you have for yourself. Well, let's go ahead and sum up what we learned here. We learned that the tax laws are written to benefit profit generators and not wage earners, right? And that comes in the form of earning your money being taxed and then being able to spend versus earning, spending, and taxing. And it makes a big difference. Using a home-based internet business, we convert personal expense into legal business expense so that we can take advantage of that EST. The government allows us to do that. The IRS, Congress has set that law up such that allows us to do that. This tips the tax law in our favor and keeps more money in our pockets while we develop our business. To be legal and ethical, we need to follow those rules, though. Our intent is to generate income. Our expenses are necessary and reasonable for what we're doing, and we have a business purpose. We sell a product or provide a value-added service at some point in the deal. All right, well, that's it. We appreciate you coming and looking at that. Again, if you have questions, get a hold of the person that sent you here, and they'll be happy to answer them or get you to us, and we'll answer them. We hope that that's helped with regards to how a home-based tax situation works. And again, if you need more questions that answers that we can't give you, go ahead and get a hold of your CPA, and they'll be happy to help you. Thanks a lot, and have a great day.